Hello, this is Brett Rentmeester, president of WindRock Wealth Management, a unique investment advisor with a focus on the macroeconomic big picture and an entrepreneurial mindset to seize on opportunity. Today, we're thrilled to have Gary Shilling back, president of A. Gary Shilling and Company and a 30-plus year Forbes columnist veteran. Gary, thanks for joining us again.
My pleasure. My pleasure.
You and I had the pleasure of speaking last summer in May at a point in time when the 10-year Treasury had dipped down to 2.2%. And like most years, almost every economist suggested rates were going up somewhat substantially. And here we sit with the 10-year Treasury flirting around 1.5%, and it marked even a lower point a couple weeks ago. Before we jump in, I want to get your views on where interest rates are headed, but maybe for backdrop, let me just cite a couple facts that some people may not be aware of. Right now, about a third of sovereign bonds have negative yields, upwards of $13 trillion. You've got countries like Ireland in their 5-year bond, where back in 2011, that bond was yielding about 17%, and that's a negative rate today. And you've even got countries now able to issue bonds at negative rates, including Japan and Germany. And of course, in the U.S., I guess we should be spoiled with these generous yields we have, but they're still positive, unlike a lot of the developed world. So I guess, Gary, right off the top, how much lower can U.S. rates go?
Well, you'll recall that a year ago I said that we were going to 1% on the 10-year Treasury note and 2% on the 30-year Treasury bond, and I still believe those numbers are realistic. We're a lot closer to them now than we were a year ago, as you mentioned a minute ago, and I think it's really because of the very weak global economic picture. The more likelihood we're moving into deflation than inflation, and of course the safe haven nature of treasuries. And there's another interesting thing is that low as U.S. yields may seem, they are much higher than almost any other developed country sovereign of a similar nature. In other words, if you look at the yield on Japanese 10-year bonds or German or French or Belgium or almost any of them, they are lower than the U.S. So an investor in those countries can buy treasuries and pick up a yield spread in their favor, plus the fact that with the dollar rallying and I think likely to continue, when they translate their positions back into their own currencies, they're getting a double whammy. They get a translation gain as well. So I think there's many reasons that yields are going to go even lower.
Gary, do you think, is some of your view contingent on whether the world or the U.S. slips into a recession or not? If we slipped into a recession, could rates go below your 1% 10-year Treasury number, or could we see negative rates on the shorter end of the U.S. curve, or is that unlikely?
Yeah, sure, rates could get even lower. And of course, one thing that we've seen in the last year is this idea of negative rates, which are in existence in a number of countries and promoted by various central banks, notably the European Central Bank, the Bank of Japan, the Swedish Reichsbank, the National Bank of Switzerland. They are all promoting negative rates. What they're trying to do is to encourage borrowers to borrow money. But, the difficulty is for these central banks is they want to have real, meaning inflation-adjusted interest rates, negative. In other words, they want borrowers in inflation-adjusted terms to be paid to take the filthy lucre away. Well, if you have, in a sense, issue or deflation, then nominal rates have to be that much lower. In other words, if you have, let's say you have zero inflation, and the central banks wants to have a negative real interest rate of 2%, the nominal rate would have to be minus 2% to get there. So there's a lot of pressure from the central banks. But one more thing, and as you know, I've been a bull on the 30-year Treasury bond since 1981 for 35 years. 35 years ago, I said in print, we're entering the bond rally of a lifetime. The yield on the 30-year Treasury then was 15.2%. obviously a long, long way from where it is now. And that decline in yield has created tremendous appreciation. And I've never bought treasuries for in the accounts we manage for yield. I couldn't care less what the yield is as long as it's going down, because of course the yield goes down, the price goes up. And actually, since the early '80s, and we have calculations, we show this, long treasuries have outperformed the S&P 500 by 6.5 times. 6.5 times.
It's remarkable.
And it's really appreciation that's done the job.
Yeah, and I think, we view the world exactly as you do in bonds, that this is a trade today. It's not the old nature of bonds where you buy them for the income and the yield. You have to look at the bond market very differently today. So with the negative rates around the world, what do you worry about? Do you think we could sink in? I mean, the countries with outright negative rates, could those go much more negative? Or do we hit a point where if they get too negative, people pull out of the system? People want their cash out of the bank accounts and the whole system goes into question. Or do you not worry about that?
I think that when we get some perspective on what's going on now, and that may take at least a couple of years to look back and see clearly, we're going to find that there's something going on here which is really extraordinary. Now, whether it's hugely negative or not remains to be seen, but there's just something very topsy-turvy about negative rates. Now, of course, the central banks are deliberately pushing them there, as I mentioned a minute ago, but this is a screwed up world, and of course, the low yields, the negative yields encourage investors to move way out on the risk curve, whether they know it or not. I mean, for example, the popularity of hedge funds in recent years, they've had a miserable performance record, yet until recently, money continued to pour in. Why? People thought, it's hope over reality. They hope that they would outperform more conventional investments. And the same for private equity, emerging market debt and equity, junk bonds, leveraged loans, whole host of higher risk instruments. This is one of the things that bothers the Fed and the other central banks, but they've got a tiger by the tail. They'd like to have higher rates because of the distortions. They'd like to have higher rates so there's something to cut when the next recession rolls around, but they don't want to do anything that'll upset the apple cart or cause investor panic in the meanwhile. But yeah, I mean, if we go into recession, and I'd say right now that's probably a 50-50 shot. Two factors that are working in that direction. One is Brexit, the disruption that's being caused there to an already weak global economy, and the other is the possibility of a further big leg down in oil prices, which I've been forecasting for over a year, as you're probably aware.
Yes.
And that would cause tremendous financial disruption. There's so much financial leverage in the energy area that if we go back to the $10 to $20 a barrel that I've been forecasting, we could have very severe financial problems, which combined with Brexit could give us a global recession.
Well, how do you think central banks would react to an outright global recession? I mean, whether we're in one now that's being papered over or not, if it's outright and most people acknowledge it, what do you see the likely playbook looking like ahead for central banks?
Probably more of the same, even more negative interest rates, more aggressive quantitative easing. But the point is that monetary policy is infinite right now, infinite. And I don't understand all the fuss and feathers over it because it really doesn't do any good. I mean, you look at quantitative easing, what happens? The Fed, for example, this program adding their portfolio back in October 2014, but up until then they were buying treasury securities, other securities which they abandoned. Or when they buy them from institutions, those institutions reinvested the money in stocks, and individuals did the same, and that's what really pushed the stock market. And the stock market, the rally really stopped at the end of 2014 when the Fed discontinued quantitative easing. But the point is that may have increased stock portfolios, but it did not increase spending on goods and services. Institutions are not going to change their purchases of goods and services appreciably as their portfolios change, and individuals, stocks are largely owned by high-income individuals. and they don't change their spending accordingly. If some guy's got 5 cars in the driveway, his portfolio goes up, he's feeling wealthier, but he hasn't got room for a 6th car anyway.
Right.
So it really has had almost no effect, but that's all central banks can do. They can raise and lower interest rates. They can buy and sell securities, but they rely on the markets to turn that into economic growth, and that simply isn't happening.
And you've talked, maybe this is more governments versus central banks, but you've talked in some of your work recently about infrastructure projects being a likely, fiscal projects being a likely next path. Do you want to expand on that a little bit?
Yeah, well, I think that if we do see a recession, and probably even without it, we're likely to see a big push for fiscal stimulus. I wrote this up actually in March of last year in our monthly newsletter. Title of the article was "The Next Big Thing," and I was noticing then, and this was long before we had Trump and Bernie come to the fore politically in this country, but I noticed what was going on in Europe, where you see all these fringe parties, and it's really a situation where there's been no growth in real, meaning inflation-adjusted incomes for most people in Europe and North America for over 10 years. And in the words of the Howard Beale in that movie Network, where he jumps out of his chair and says, "I'm mad as hell, I'm not going to take it anymore," that's where voters are. And so they're turning to the fringes. And my argument is that this is going to put a lot of pressure for fiscal stimulus because, I mentioned a minute ago, monetary policy is impotent. And I rather suspect that we'll see that even without a recession. A recession would certainly make it even more likely. But when we get whoever the new president is in Congress early next year, I rather suspect we'll see that. And there are 2 areas that I've earmarked as possible for big fiscal pushes. Spending that would create jobs and incomes fairly directly. One is infrastructure spending, and we certainly need it in this country: roads, bridges, railroads, all kinds of electric infrastructure, and so on. And the other one is military spending. That would be more likely to be a big push if Republicans controlled Washington. But they would point to China building these artificial islands in the South China Sea for military purposes, Russia getting back into the empire business with the invasion of Ukraine, and of course Japan coming out from under their neutral policy that they've had since World War II. So those are areas that I think we could see big fiscal stimulus, and that could revive the economy. Otherwise, as I think you know, I wrote a book in 2010 called "The Age of Deleveraging: Investment Strategies for a Decade of Slow Growth and Deflation." We're into that 9 years, and I forecast in that book 2% real GDP growth. So far in this expansion, it's averaged 2.1%, almost exactly on my forecast. And I think that will continue until the excess debt that was built up in the 80s and 90s is worked off. But that could be cut short if we got a massive fiscal stimulus in reaction to this mad-as-hell voter attitude.
Yeah. And turning back to bonds, let's assume you're correct. And this, as you said, this 35-year rally of a lifetime takes you below 1% in the 10-year. What are you looking for as a point to exit the bond trade? Because the other side of this is going to be ugly at some point. I think we'd both agree. But what would you look at as warning signs that maybe yields have come down as much as they're going to and a time to exit?
Yeah, well, I don't agree with that. I know that the media almost uniformly says, when yields go up, when yields go up, when yields go up. Well, hey, for 35 years I was saying, make money when yields go down, make money when yields go down. I don't understand it. There's this feeling of somehow that bonds are undesirable, and it's always the idea of yields going up. And I'm saying yields are going down. And there's no reason. I mean, if we get into a global chronic deflation, there's no reason that yields will not stay low. And if you look at this 30-year bond, let's say we do get down to 2%, my target. If we're running deflation at that point, say negative 2%, that difference between 2% yields and a minus 2% on prices, that's 4% in real terms. 4% real return. That's a very high return by historical standards. So what I call the bond rally of a lifetime, the appreciation might be over, but that doesn't necessarily mean that treasuries then would be a horrible investment. Now, if for whatever reason we get so much fiscal stimulus or other activity, that economic activity, that inflation is recreated, and I don't expect that, but if that were to happen, hey, then you could have a sell-off in bonds, yields go up. But I think that's unlikely at this point. But of course, the chorus has been for 35 years bellowing, rates are going to go up, rates are going to go up, rates are going to go up, and I've been saying quite the opposite.
Yeah, you've been steadfast in your view, and I give you credit for that. That's a hard thing to do through a long period of time like that. So you're going to have to find something new at some point in the future. It's going to feel like
yeah, right. Yeah, well, I've thought about that. I know. I think there are other things. One area that we're looking at is the dollar. I think we may be in for a long upward climb in the dollar, but that's something we're taking a look at in terms of what might be the next big thing beyond this bond rally of a lifetime.
Great. Well, thank you so much for your time, Gary. In closing, I wanted to mention that you've got an excellent monthly newsletter, the Insight newsletter, that can be found at www.agaryshilling, and that's SHILLING.com, or by calling 888-346-7444. Gary, thanks so much for your time today.
My pleasure.
We'll talk
Bye.
soon. Bye-bye.